Hello everybody, this is Eddie Ghabour, owner of Key Advisors Group. Please subscribe to our YouTube channel for up-to-date videos as well as maybe some things that you can do with your personal family's net worth that may fit within the risk tolerance and goals for your family. Today I want to talk about the potential of the Federal Reserve raising interest rates. It's been a while since we've been in a situation where the Fed is now starting to tighten monetary policy. And I want to talk about how that could affect interest rates as a whole. We many times are non-consensus in our market calls, as you know, those of you that follow us. And one of the calls that we're making now is the fact that we don't believe that the longer term rates, specifically the 10-year bond, is going to actually be going up over the next 6 months. It's going to stay range bound for sure. You'll have up days and down days. But we think when we look at the 10-year bond, that we're going to see rates actually going down over the next few months, not up. And that's not consensus, because consensus seems to think that because the Fed is tightening monetary policy, that the longer term bond rates will potentially go up. And they could absolutely be right and we could be wrong. But our opinion and why we believe that is because we think the economy is really slowing down at a faster pace than what most people have priced in. And many times, we've always used this saying here in our office that the bond market is smarter than the stock market. That's our opinion. Many may agree, many may disagree. But the reason why we think that is because when we look at the 10-year bond rates, many times we like to look at them as a prediction of potential future growth. And because we think the economy is actually going to be compressing due to how bad inflation has hit the consumer, we think retail sales are going to really struggle. We think earnings are going to really compress. We think GDP is going to be coming down from a sizable 7% fourth quarter to potentially 2, 3, maybe 1% in the second quarter. I'm not an economist, so we'll just have to wait and see how that shakes out. But the bottom line is that we have a very strong conviction that we're going to see a slowdown that is well below consensus. And many times when you see that slowdown, the 10-year bond rates will start to decrease. So it's going to be very interesting to see how the bond market reacts to the Federal Reserve raising rates. Keep in mind, the Federal Reserve, if they raise rates or when they raise rates, they're only affecting the short-term rates. They're not really affecting the long-term rates. So you can have a scenario where short-term rates are going up, long-term rates are going down. And if you get a scenario where the short-term rates are higher than the long-term rates, that's when you hear people like myself talk about what we refer to as an inverted yield curve. And that inversion of the yield curve traditionally has not been very good for economic growth. Many times it has signaled that a recession is coming down the road. And that, frankly, is where we think the setup is going into this second quarter. So this is why one of the investments that we have been investing in for our clients are longer-term treasuries, bonds, because they many times will be more sensitive to interest rates. So when you're looking at bonds, they're not all created equal, right? You've got corporate bonds, you have high yield bonds, you have investment grade bonds, you have government bonds. Only you can really determine what's best for you and your family based on your risk tolerance and your goals. For us, we've tried to have the quality of the bonds to be extremely high. We are definitely leaning more towards treasuries and on the longer term side, because this is a year that potentially bonds won't be as boring as they are in bull markets. So we are making these allocation shifts, again, in anticipation of a slower growing economy, and because we're hopeful to get some upside within these bonds as a 10-year bond starts to go down. Last thing I want to talk about is the relationship of bond prices and interest rates. Many times there is a disconnect with that. And what I mean by that is if rates are going down, that means bond prices are going up. So the reason for the purchase is if we think rates are going down, we believe that we're doing that because we're going to get some appreciation on the bond side. Obviously, there's no guarantee to this, but that's how we're positioning, and we actually continue to increase our positioning there because of our concern of a slowdown here in this second quarter that we've been so much anticipating because, again, we think that many have it wrong in regards to GDP growth. And we think it's going to underwhelm and maybe cause the Fed to even rethink how many rate hikes they're going to do. So these next 3 months, there's going to be a lot of fireworks, a lot of data, and a lot of things that we're going to need to be doing to risk manage portfolios. So thank you for your time today. I hope you got some value in us talking about bonds and why it may be something for you to consider with the portfolio you're managing for yourself. Thank you, and make this a winning week.